Hello, everyone, and welcome to the State of Deposits, the first session in the spring series of the Deposit Summit. I'm Matt Doffing, the summit's organizer, and it's an honor to have you here with us for our first ever education series. In case you haven't followed the Deposit Summit, we're a cooperative of experts on a wide range of deposit-related topics who come together quarterly to offer sessions like this to help banking executives navigate a rapidly changing deposit marketplace. Please consider following us on LinkedIn as a way of supporting us. You can also sign up to join our other sessions there. We will post all presentations and recordings and materials there, as well as information on our summer series, which will cover age and deposits. Now for the state of deposits. We're focused today on a big question on most executives' minds. Is the current deposit landscape just interest rates? I put that in bunny ears. Or is it a more fundamental change that's afoot? Here to take us through is Neil Stanley. Neil's the founder and CEO of The CorePoint, which he started in 2010. He has over 30 years experience as a banking executive leading family-owned bank groups. He holds 2 deposit patents, and he teaches at the graduate schools of banking across the country. Thanks for being with us, Neil, and take it away.
It's my pleasure, Matt. I'm excited about this inaugural launch of the Deposit Summit. I think this is a great idea. So, we are going to talk about the state of deposits and why this landscape is different than ever before. And that sounds always, when somebody says things like that, it seems so ominous, like it's existential. Like, well, in many cases, we are doing things that we've never done before in our society, in our industry. And so it does sound ominous, but it is the reality of a world today. So as we engage today, we're going to be seeing a lot of information. We're going to start off with this slide. This is the FDIC quarterly bank profile, and it shows what happened with deposits as we moved through time, going back to 1984 and coming to the present. We saw the ever increasing increase of deposits when you look at domestic office deposits growing until they didn't. And so we see that it peaked and then it started down. And what declined was in large part those non-interest bearing deposits. They had grown so dramatically during the pandemic and then they went back down. The non-maturing deposits here in the orange, they grew as well. These are interest bearing up here in the orange. And then they started to go back down and they have started to grow, unlike the non-interest bearing deposits in the gray. The piece that grew percentage wise so much were CDs, and they grew because not because anyone thought they were the best way to do things. Bankers don't really like paying more for term deposits, and depositors don't like locking up their money. But the reason that the industry grew deposits, term deposits, was that it was a better alternative than raising the rate on non-maturing deposits. As Fed funds started to go up, the market was saying, what are you going to do? And the bankers said, I know, let's offer term deposits that are discrete offers, and we can do that instead of repricing all of our non-maturing deposits. And so Matt asked me to overlay the interest rates. So this is the Fed fund rate overlaid on the exact same timeline from 1984 until present. And you can see that with Fed funds that were at some points in time over 10%, overnight rates, yes, were over 10%. And then they came down and then they went up and then they went down. But whatever happened with rates, deposits were pretty steady, as you can see in the blue line behind it. But when bankers today think about rates, a lot of them, particularly if they started in the last 15 years, think of low rates being correlated with lots of growth in deposits. And you look at the history of these two things, interest rates and deposit growth, and you see ultra low rates from 2009 until 2008, excuse me, from until 2018, I should say, and then going up and then going right back down to ultra low rates. And during that period of time, the ultra low rates created a lot of deposits. Did they really? I'm going to suggest that it wasn't ultra low rates that created deposits. I'm going to suggest to you the reason that deposits grew after the Great Recession was plain and simple fear. People feared that they would be in trouble with investing funds because of all of the dynamics of the financial environment. So they put their money in the safest places that they could find, banks and credit unions. And so that caused deposits to grow even though rates were low. And then when the pandemic happened, the deposits grew not just because rates were low, but they grew because we were putting so much money supply into the economy. And so that money supply caused deposits to grow in very great amount. And for the first time in decades, we saw a decline in deposits in 2022, 2023. And now it's started to go back up, but we're at 18.4 trillion as of the fourth quarter of 2025. So that gives you a little perspective on the history of banks being becoming volatile after being on a very smooth transition path until it was dramatically up, dramatically down, and what we have today. So the three questions for this morning that we need to think about is what's actually changed in our environment? What are we doing differently? What are we sensing? What forces and behaviors are creating impact that we as financial institutions have to address? Why do the old deposit assumptions seem to fail now? There is definitely risk in legacy thinking. Now, in the financial industry, we tend to think that legacy thinking is safe because it's stood the test of time. We're regulated and we don't really want to experiment with things that might be proven to be faulty in some way. But today I'm going to suggest that there's more risk in doing legacy things than there is in doing new things. Not completely true, because there are some new things that you could do that would be problematic, but there are things that you could do that have been tested in small markets, in environments that there was a lot of testing and learning, and we can learn a lot from that. And I think that's what this deposit summit's going to be all about. What should leaders be asking next? How should we be framing the 2026 and beyond conversation? So this is about how to deal with an environment that is focused in on deposits. I was at Acquire or Be Acquired earlier this year. And at that conference, the keynote speaker said there are three things that 2026 is going to be about. It's going to be about talent. It's going to be about technology, and it's going to be about deposits. And it really was so shocking to me that after all of these years and starting my business in 2010 to help financial institutions deal with deposit strategies, and people would say it's just not interesting to us because deposits are like oxygen in the air. We have plenty of them. Why would we worry about it? Why would we take time with deposit strategies? Deposits were abundant from 2008 till 2015. There were all these years where we just didn't have to worry about it. Unfortunately for our industry, that time frame of focusing in on other things caused us to displace or misplace some potential research that could have happened because it was like we have bigger fish to fry. There are more things that are important today in 2013 than deposit strategies. I look at it a little bit like this. It would have been like, it was like for me, selling drought insurance in the midst of a flood. The banks were flooded with deposits, and I was saying, when the drought happens, you're going to need these better tactics. You're going to need to make sure that you deal with the weaknesses that are inherent in your approaches with your products and your processes for deposits. But people said, I just don't think that's an issue for us. We have bigger fish to fry. But that era is over. Since 2022, we have been in an environment that's not like what we saw before. We are learning to compete again. We competed for a long time in lending. We know what it's like to compete for quality loans that are properly priced. Now we have to compete for deposits that are properly priced. That's the raw material to the factory that we have. And the era of automatic deposit growth, as we saw in the chart, has ended. So Fed funds set the backdrop. And we did the correlation between interest rates and deposit growth. But the reality is, interest rates are a factor. They are definitely a factor of what we're doing. And it creates an environment that we need to be mindful of in terms of price. But the Fed fund rate is something that bankers many times thought, oh, this is a transitory thing. We're going up in rates and then it's just going to come back down. I can tell you that from an economic standpoint, it makes little sense to think that lower rates are going to solve the deposit problem. Now, we talked about the correlation between low rates and deposit growth. But if you look at pure supply and demand, the idea that you pay people less for something doesn't get you more of what you're asking for. The less you pay people for anything, the less you're probably going to get of it. So if you have low interest rates, it's going to not incent them to bring deposits to you. So short-term market rates might go up, might go down. We thought for many years now that interest rates, for the last 2 years, we said, oh, rates peak, they're going to come down. And they have come down a bit. They were at 550, now they're at 375 for overnight Fed fund rate. But what's actually happened is long-term rates have gone up in the last 12 months, while short-term rates have dropped. So expectations are mixed. There have been expectations for depositors that maybe the rates will actually go up. And now the Fed funds futures market is thinking maybe rates will go up. So there are national benchmark rates, which show very modest. If you look at the FDIC rate caps and you'll see what the average rate is, very different than what people today expect for their rates. And so our management response to this market rate environment needs to be a segmented pricing strategy, product flexibility and product design, and retention capacity. What's your retention strategy? If it's rate matching, you're in a difficult position. If rate matching is your retention strategy, you need to look at better alternatives. So over the course of this summit, I think you're going to get a lot of great ideas. But ultimately, it's a function of upgrading. Yes, I said upgrading the team on the field. If the team that you have going after loans is a highly professional team working on consultative engagement, a trusted advisor status, that makes all the sense in the world. If simultaneously you have a team on the field for retail deposits that is not what I just described, you have a challenge because the attraction of the raw material in today's competitive environment requires the same level of professionalism that it takes to get loans today. And I know that's shocking to some senior bankers today. The C-suite bankers are used to an environment where we have what I would consider more the order takers. Maybe you might say product pushers, where they use charm and hustle. They work hard. They're loyal. They are trying to do the right thing. They're focused in on service. All those things are good. Not trying to put them down. But if that's all your commercial lenders have, it wouldn't go very well. Your commercial lenders have to understand that it's time to execute on the front line. You must have a sequential sales process. You must have some products that intrigue. You can't just be selling commodities unless you think you're going to take a rate war and win a rate war. Winning rate wars is not what community banks are going to do well because we have costs. We have people, we have facilities, we have to cover those costs, and we need to create a margin to do that. So as we think about this, there are 5 forces that have changed all at the same time that we want to cover in today's presentation. And those 5 forces are very, very important to understand that the deposits got expensive. And when I say expensive, not like the 1980s, but the rate environment flipped to the point that funding costs overnight were very, very different than they had been just a few years earlier. And depositors, whether they be consumers, businesses, nonprofits, government entities, municipalities, they all are getting smarter, and they're getting smarter very fast with AI. Non-bank substitutes have become very real. Money market accounts, they grew dramatically from about 5 trillion to 7.4 trillion in recent data. Remember how we talked about how money supply grew? It didn't all go into banks. It's gone into other things like money market mutual funds. And now we're getting stable coins. Stable coins are going to pull money out of banks. How are you going to deal with that? Stable coins were not designed, even though we're going to have a session on deposits and stablecoin, there was nothing that was designed in stablecoin for a bank's perspective. Banks were part of the audience for sure, but it wasn't like we designed stablecoins to benefit banks. No, we designed stablecoins to benefit people who want to move money and for the US Treasury. So Bitcoin doesn't have anything to do with the US Treasury, but stablecoins demand US Treasuries be purchased anytime a stablecoin is issued. Do you not think that our government thinks that's a great idea? Yeah, it might hurt the banks a bit. They'll be okay. That's how this thought is working in Washington. This is not about helping community banks at all. Stablecoin is going to pull funds from community banks. The entire banking system might benefit in some ways because there are some banks that are going to capitalize on stablecoins, but it's not going to be every one of the 4,300 banks and 4,300 credit unions that are going to capitalize on that. And AI, folks, is changing the negotiating power. So it's very common over my career to think that when I engage a non-banker, a client, a borrower, a depositor, that I'm going to know much more about what's going on with banking than the non-banker. But today, everyone that has one of these in their pocket essentially has a CFO level guidance with the AI tools. It can engage in ways that are quite powerful to understand what the opportunities might be for the money that is being considered to be put into the bank. So all of these things have changed that negotiating power and the product design flaws that are out there. Yes, there are some design flaws, and we shouldn't be shocked because if your checking, savings, and CDs look like they're the same as 1960, 70, and 80s version in a world that has changed with the internet and now with AI, how could we be shocked that they may be exposed? There's maybe some things that we didn't consider to be a big deal back then are going to be an issue. These are real situations. So as we think about that, there are opportunities that we need to engage. When we think about deposits are no longer competing only against other banks, I mentioned stablecoin. Here are the money market accounts, crypto with the stable coins, payment ecosystems, brokered deposits, and US Treasuries. US Treasuries went from 40 years ago, treasuries held in the hands of the public were about $5 trillion. Today, they're almost $32 trillion. Yes, total bank deposits, 18 trillion. And yet there's $31 trillion of competitive investments. It could be in bank deposits, but they've chosen to go into buying US Treasuries instead. Keep in mind, there are no overnight US Treasuries. Bankers tend to say, oh, we want non-maturing deposits. The interesting thing about that is the US government doesn't issue any non-maturing deposits. They all have at least a 90-day T-bill or longer. And the market has embraced that and put in 31 some trillion dollars in US Treasuries. And banks have grown only a small part of that grows from 5 trillion to 31 trillion. People are not putting their money in banks by default. So everyone that puts money in a bank can fall into one of these three categories. You have the content. Yes, they are legacy people. They are not very rate sensitive, at least for now. Inertia is a driving factor for them. Relationship and loyalty is a factor. But they are vulnerable to some sort of trigger event, something that happens in their world that changes the way they see things. And that could be changing them from content to one of the other categories. Second category are curious. And the curious are people who ask very interesting questions like, hey, the world's changed. Should I do something different with my money? When I was a young person, the bank was the default place to put your money. That was before 401ks started in 1981. And the curious person today who asked the question, should I do something new with my money? Not only has all these other options, but they have AI to help sift and sort and consider other things that they could do. It makes them aware of alternatives. They can do research really easy, but maybe they're not ready to move so quickly. But who makes a very curious person? The heirs of senior citizens. And if you're like most banks and credit unions, a big portion of the funds that you've taken as raw material for that lending operation you have come from seniors. The baby boomers are a huge generation that has a very massive net worth. And if those baby boomers have children that start asking, hey, mom, dad, what are you doing with your money? There might be some better options out there for you. Wow. How's that? How are you going to deal with them? How are you going to show respect to them? And of course, then there's that other category, the shoppers. And the shoppers are people who already have some antagonistic questions. Their questions aren't really legitimate questions. Their questions are, why can't you keep up with the Edward Jones offers? Why can't you keep up with the highest rates being offered in the marketplace? So a mistake here is treating everyone the same way. Occasionally, I'll talk to credit union particularly, and they'll say, hey, we don't want to differentiate pricing. We want to give everyone a great deal. Well, good luck with that, because if you give every depositor a great deal, by definition, you are challenging your borrowers. Because if your cost of funds goes up and makes you uncompetitive in lending, you are not giving your borrowers a great deal. So you have to find an equilibrium. You have to find a place that is fair to the depositor and fair to the lender, and creating for your financial institution the ability to make a margin that allows you to pay your people, and for a bank that you can create capital from that. So the banker is no longer the expert in the room, the only expert. Years of training and experience, regulatory and compliance knowledge, all those things you have to have. But AI is leveling the playing field. And the CFO level guidance is available to them in real time. And there are things like CD exits and penalty structures that are literally irrational. If your penalty for early withdrawal on a certificate is based on the interest rate, you have a very irrational product. Now, what do I mean by that? Well, if you want to keep expensive deposits, that would be odd. Well, guess what? The higher the interest rate, the bigger the penalty. That's what most financial institutions have when it's so many months of interest. Because the higher the rate, the bigger the penalty. Well, folks, if you had a 6% CD on the books, you'd probably want it to mature early today in a 3.75 Fed fund world. But if you had a 2% CD or a 1% CD, the penalty on those pretty small based upon so many months of interest, unless you had a huge number of months. So the structure of penalties makes no sense in today's environment. If you are doing so many months of interest, stop. Think about what you've inherited, because we know you didn't design this product. You didn't 2 years ago say, well, I think we should do CDs based upon so many months of interest for the early withdrawal penalty. You inherited it. You've not thought about it because it didn't matter that much. And when interest rates rose, most depositors didn't react because no one prompted them. But today, Intuit has just signed up with OpenAI, which produces ChatGPT. And if you don't think that Intuit's TurboTax, QuickBooks, Quicken, and Credit Karma are going to start advising depositors when they see that they have investments in bank and credit union term deposits, when they see the interest income, if you don't think that OpenAI is going to start making recommendations about how to manage the options, yes, CDs have options. They have a put option. And what's going to happen is those put options are going to be very efficiently managed by AI. So what used to be a product quirk, like, oh, kind of an unusual thing. We did it for simplicity. We did it because people expected it. They grew to be comfortable with so many months of interest. But they're static penalties, whether you have had the CD for a day or 35 months and 20 days. It's the same if so many months of interest are being charged. The fixed maturities with no flexibility. Oh, we're going to just say 6 months, 12 months, 24 months. Uniform rates regardless of depositor value. Really? You're going to have depositors who are all in with you and you're going to pay them the same rate as somebody who's calling up and you've never met them? Don't you think relationship pricing makes sense in some ways? So there's so many things going on that we've seen as legacy. But today, AI is guiding the exit strategy. It's producing real-time alternatives for those depositors, and they can take advantage of your bank in very powerful ways. And it's up to you. The depositor doesn't create your account structure. The depositor didn't write your disclosure. Your financial institution owns those structures and those disclosures. And if you have left them up to legacy and not reconsidered them, whether they're going to hold up in an AI assisted world, could be very problematic. So we know this. The commodity approach, static rates, random specials, exceptions by ad hoc instinct and reactions that let the money leave and then try to get it back and claw it back. Those are the commodity approaches. But the segmented pricing logic, product relevance by depositor, what's important to each depositor, understanding not everybody's a sleeper. Some are curious, some are rate shoppers. How do you negotiate with them? Like a commercial lender would negotiate. That's what we're after here today. That's what we're trying to address because if your evolution in retail deposits and how you're dealing with the funding side of the balance sheet hasn't evolved, it's not unexpected. It makes sense that you didn't spend time and energy on it, but it doesn't make sense from here forward because you are at a position where you're spending millions of dollars on CD interest expense. The rate paid, deposits should be evaluated against their alternative. You are looking at wholesale funding, and we see lots of wholesale funding. We see lots of broker deposits. We see listing services, all of these things. There's nothing wrong with them as a cherry on top, but it shouldn't be your core business because there should be a core competency. That's what financial institutions have done for decades, is they went out in the local market and they were able to attract the confidence, express confidence and attract funding that then they could use to underwrite credit in that local market and make a spread doing it. And if you simply go to the wholesale market, you have no value proposition in that raw material. You're just getting the same that anybody else could. And so you should be understanding where the alternative costs are, understanding how what your spread is each month. You should look at how many deposits we got, how much volume we got, and what the cost was. And you can take that cost and compare it to FHLB and look at that spread and that volume and put those together to create a benchmark. We publish that at the CorePoint on a monthly basis. And when you start looking at that, you see that you have a full picture in terms of what's valuable. So the decisions that we need to make boil down to this. How can we get an oversized spread and an oversized volume simultaneously? I've had so many bankers say to me, yeah, we're really good here at deposits. We have a super low cost of funds. And then you start looking at their volume, they've shrunk the bank. So if you're shrinking, you're losing profit. I don't care if you have a super low cost of funds. If you could grow the portfolio and have a very healthy spread, you're going to make more money. Simultaneously, I've heard people talk about how proud they are of their growth, and then you look at it and go, well, they're paying over wholesale funding. There's nothing to be proud of there. You should be able to go get funding at less cost than wholesale. That is what we need to do to be effective. So a winning institution competes intelligently, not just more aggressively. Frame it with profitability, create better architecture for your product, and create timing for promotions. Only run promotions when you have the least amount maturing. That's when you want to bring in new funding. And then you want to use things like companion accounts instead of just offering CD specials. So companion accounts are powerful growth engines. Use frontlining, equipping, enabling, and empowering to make sure that your team is ready on the field. We're in the NBA playoff season, and I guarantee you the best teams are not sending in a play-by-play for every time down the court. They are letting their team execute with some general design and then go get it, go make it happen. And that's what you have to do here. Create a general design, understand the sequential process, and let your team operate. It doesn't mean that you let them operate without guardrails and guidelines, but you have to create a platform that allows them to navigate and respect that curious and negotiate with that shopper and make sure that you're getting funds from the content at a price point that makes sense. And when you do that, you can do much better at bringing in deposits at several different price points. One of the key things it talks about better retention response here. Let me emphasize that 26 years ago, we discovered how you could better manage the rate shoppers challenge of match it or lose it. And we came up with limited edition savings. The product that you use only when you have a depositor who says, I don't care about any of those CD offers that you just gave me. Unless you match Edward Jones, I'm out. Get me a cashier's check. That's when you offer them the high yield savings account that they can withdraw anytime. It's a variable rate. They cannot deposit to it, so they can't reprice any of your other money other than the money that's going out the door. And if you lose it, you've lost any ability to be profitable on it. If you keep it, you can keep a spread, even if it's small, compared to Fed funds. So product design matters. We should be looking at customizing the maturity dates. We should be looking at fairer withdrawal structures, like we talked about, having a mark-to-market withdrawal. We call them enhanced withdrawal options. Relationship linked offers. So we give respect to those people who are presenting value to us beyond just this one transaction. The companion accounts. The companion accounts pair CDs with savings. It's a buy one, get one. If you open up a high yield or you open up any sort of certificate with us, at least a certain term, you get a buy one, get one, high yield savings up to the dollar amount that you put in the term deposit. And by doing this, you're going to do things that surprise, very positively surprise your marketplace. That's what we're all about here. And that smart approach that I mentioned on limited edition, that retention that you bring out when somebody says match it or lose it, very powerful product. So banks are modernizing the depositor experience. We talk so much today in many, I see in banking journals talking about hyper personalization. And I get it. We want to be showing respect in our payments and our credit, but I don't see it happening without some guidance from folks like us to move forward because the industry has seemed so stuck on the commoditization, and we keep going back to the well of, I just want a whole bunch of non-interest bearing deposits. I'm going to tell you that in an AI world, the idea of non-interest bearing deposits to the people managing their money sounds like mismanaged money. So I get how you want non-interest bearing deposits, but you're going to have to find that ground between non-interest bearing and fairly priced. It's going to take a dynamic to do that in today's and the future environment that you're going to be working in. So the front line is closer to cost of funds than many executives realize. What we're talking about there is that we need to make sure that we are working in a very confident and capable environment to get the growth that we need. We want to make sure that the at-risk depositors are caught before they leave and maturing those renewals. There's a good strategy to create a provocative, highly engaged approach to them. I love technology, and if you can automate deposit activity, that's great. But if somebody's going to put $100,000 in my financial institution, I want to make sure that part of our omni-channel conversation is that they can talk to somebody who's a financial advisor. It's not about just automating. Automating is a part of what we can do, but you can automate yourself into losing deposits, losing profitable deposits. Because in an AI world, you're going to see the automation and AI combination being very, very powerful. And most community banks do not have the technology to keep up, but you do have the people to keep up. You do have the capacity to work those relationships. Now is the time to do that. An exception discipline, how you handle that margin, only when forced, only when negotiation about giving something, but getting something in return. And that's really where we're at is that process of give, but get, give, but get. The historical non-AI computers didn't do that very well. Most of what we think about in terms of online account opening is a decision tree process. It doesn't negotiate. It simply says, here's the decision tree. If you say yes to this, then you're going to get this. If you say no, you're going to get this. And it doesn't work well as an advisor. Now, AI is going to change that. But today, charm and hustle are things that we value, and we want to combine that with relationship pricing and strategy and a good process. And it's really hard to get charm and hustle out of an online only system. So I'm not going to spend too much time on stablecoin. I know there's a great session on stablecoin that is going to occur here. I know my associate Stacy's part of that, and that's just a wonderful session. It's all about two rails, two things you have to think about: the payment rails and the deposit displacement, because it's going to affect banks in two ways. It's going to take funds out of the bank to fund stablecoin, and then it's going to use a different rail than what we're used to in banking. It's not using ACH. It's not using the RTP and the FedNow. It's going to use a different payment rail. So none of that stablecoin was designed to benefit and bless banks. It was designed to benefit the U.S. Treasury, and it was designed to benefit the people who are trying to make payments. And I get it. And we should be happy about that as consumers and as business people, but as financial institutions, you're up against it. And so it's time to take that seriously with the Genius Act. And so think about how you're going to deal with the transaction activity and with the relationships and the balances that are impacted by that. So, 5 questions. Here are 5 questions that every executive team should be asking. And you'll note that I put down here, I gave myself a note. I said, do not rush this slide. Ask each question slowly and let the audience feel the gap. So I'm going to try to honor my own. I like to get going here, but I'm going to honor my own request here. Do we know what deposit profitability really means for us? So Steve Wolford is doing a session here for the Deposit Summit. He's going to talk all about this. It's essential that you tune into that. But funds transfer pricing is a big part of what big banks have done for a long time, and no bank is too small today to use funds transfer pricing. Number 2, which depositors are we actually trying to win and retain? It's a critical question that we need to ask today because yes, we want to be a community financial institution, which means we serve a broad spectrum of depositors. But you need to understand where you're going to really put your effort because you cannot be all things to all people. The old saying, you can please some of the people some of the time, but you can't please all the people all the time, applies to deposits. So where are you going to deal with that? And third, where are our product structures outdated or a keyword here, exploitable? And exploiting has to do with finding something that you didn't intend and you put it in there and nobody noticed. It'd be like leaving the vault door unlocked and nobody knew to break in. Well, it's one thing if nobody ever breaks into the vault because they just assume it's locked. It's another for you to know that the vault door is unlocked every night and let it continue. So those early withdrawal penalties and some of the things, we publish a list of 32 best practices for interest-bearing deposits. I'm going to suggest you might want to contact me, Neil at thecorepoint.com, and ask, can I get that list of 32 best practices? Might be a good thing to ask, uh, to assess when you're looking at these product structures being outdated. Number four, are our people equipped to negotiate deposit relationships intelligently? It doesn't make sense to hire people, pay them a good salary, and just have them try to work with charm and hustle. Again, not putting down charm and hustle. I like charming and people who work hard, but I have been very frustrated by some of the most incompetent, charming, and hustling people. But if all they can do is say, Mr. Stanley, we so much value your business, but they cannot answer any of my questions, I'm not very impressed. Number five, are we preparing for new payment rails and the AI assisted rate aware customers? This is all about making sure that we are up to the challenge and the rest of the industry, which is moving to adopt AI much faster than most banks for legitimate reasons. Banks have been regulated. Banks have to stand the test of if we make a commitment, we have to be honoring those commitments. And we cannot casually uh, implement AI because generative AI makes up stuff. That's what generative means. It creates things. And if you give it enough data, it will create things that are in line with the data. But if it gets some extraneous data that doesn't fit your model, it can create options that you don't want. But the depositors don't care about that. So are we prepared for them having questions that really challenge us deeply? So for deposit structure, we need to think about the targeted deposit growth, pricing discipline, improved margin protection, empowering the front line. I've dwelled on that quite a bit. Retention. It's one thing to go get deposits, and we should go get deposits. But it's another when everyone you know is hiring treasury management specialists to go out and try to get deposits, the low-hanging fruit. So understand that if you have relationships, how are you going to keep them satisfied, keep them understanding that you are the place that they are, that their bread is buttered because you're taking care of them, and operational consistency, not relying on random things like promotions, being predictable, being focused in on managing the outcomes. So I told you I liked AI. I took this deck and I gave it to Notebook LM. You can see down here in the corner it says Notebook LM. It's a Google product. And what it did is it put together one page that kind of encapsulates all of the things we've talked about. The 15-year of automatic deposit growth has ended. We need to compete against rate sensitivity and non-bank competition. Institutions must shift from reactive commodity mindset to smart managed strategy, utilizing product structure and AI aware negotiation. So we talked about how the old playbook is broken. This new structural strategy playbook is over here, and some of the differences in how we approach pricing, tactics, and retention between the commodity approach and the managed relationship. So I just thought I would bring this up, have you understand this, have you take a look at this, and hopefully you can share it with the rest of your team to be prepared. So today's sessions, I know you're going to be able to dial into a retail a track where there's going to be talking about how to do many of these things. Engage FI and Cole Analytics are going to talk a lot about that. And then you're going to see some really good stuff with stablecoin and Bitcoin conversations and how that's impacting our industry in this environment. So to close us out, this is not just a rate story. If you want to frustrate yourself, bet on rates and say, well, we'll just keep doing what we've always done, and maybe the rate environment will work out and we will be in a great position. This is truly a strategy story. I like strategy because strategy is all about anticipation and taking action based upon the anticipated environment of the future. And so when you do that, you're in position to act based upon an anticipation. If you don't anticipate, then you're just reactive. So today, it's a behavior story. And behavior is changing. The behaviors you saw in the generations in the past are going to be different, not because they're different humans, but it's because we're going to be assisted by technology that's super efficient, super effective, and very, very timely. You don't have to go out and get an expert to advise you on how to manage your money in the future. So it is a product story, but it's definitely an execution story. I can tell you that we have helped many financial institutions over the years. They can have the same products, but the people on the field, the people who are in the trenches working with your accounts, working with your relationships on the phone, on video, in person, they're the people who are going to execute. And you must equip and empower them. If I want to make one point, it is that the world is changing and you need a team that's up to the task. So with that, Matt, I am going to turn it over to you, sir.
Thank you so much, Neil. Thank you for walking us through all of that. I really do hope that all of you will attend, just like Neil says, our other sessions on those two tracks. There really is a wide array of things for deposit leaders to consider right now as they try to, we even, in fact, have a session on modernizing the deposit offering. So thank you for joining us. Do look to the Deposit Summit page for Neil's materials and our other presenters. Thank you, everyone, for joining us.